the date. But we, great, there we go, good. We intentionally tried to have this event on a Thursday night. So a lot of students from Montana State and Montana who are going to come over, other universities from outside of the Spokane region will be there in attendance. We usually have 150 plus people in the room. There's also a lot of very smart, wonderful people who will come and give us their views on both equity markets, fixed income markets, and just the investment landscape in general going forward for the next year or two. So we've had some very prominent speakers. It's a great networking opportunity for you as students as well, if you're looking for a job in our region. So we encourage you to attend. That following day on Friday is when we'll actually do the presentations there. And then from there, there are opportunities to progress further to a sub-regional or regional round, or perhaps even the global one. If you make it that far, the CFA Institute would actually pay for your team to travel to go do that live, which is a pretty amazing opportunity for you from that standpoint there. So that's kind of the overall competition timeline from what we have there. Any questions on the rules, on formatting, team structure, anything there? Okay, good. Friendly reminder that an error of omission is not your friend. So if you're like, oops, I didn't know it was in the rule book, you should all have been given the rules of the competition. If you weren't, talk to your advisor or talk to Ryan. We'll make sure you have those, but we had one team disqualified a few years ago. I do not want that to happen to you on that standpoint. Okay, so with that, thank you everyone for joining with me on this. Now we're going to turn it over to the Potlatch team to give their presentation. Okay. No. Where are we going, guys? I'm just going just on. Yeah, investor resources. Yeah.
Is anybody from Spokane on the higher levels of competition? I see. I'm a competitive guy. This has got a lot right here, right? They're gonna work together.
Perfect. Okay, I'll let you guys take over. Thanks, guys.
I want to do the interactive version.
Yeah.
So we got one that kind of builds and it has animation in it. There's like that one better. Actually, go online and check it out. So clicker is, am I armed and dangerous here? Yes, that's correct. Yeah, we'll do it this way. And people online can actually what we ought to do, because of the it's taking up more, there's more presentation, there's screens. So we're looking at the internet. So what I'd like to do,
we need to actually
let's
share.
pull it up as a PDF, and then I can go full screen view.
Okay.
Would be a better way to do it, and then everybody can see the whole.
So if we download.
I wasn't smart enough to figure that out by myself, by the way. Somebody in the office showed that.
Yeah.
That's PDF right now, right?
Is that what we need?
So there should be.
Is that what you want? Well, that's weird.
Actually, I saw it. PDF. So, right. There we go. Exactly. View. Full screen mode.
Right, can you see that online? Do we already shared our screen?
I cannot see that online.
Okay. Thank you.
That's too bad. It's looking good, right?
Yeah. Gotta come live next time.
I'm gonna say bonus points for folks in the room, right? They're all nodding here.
Okay, now we can see the presentation.
All right.
Well, we're gonna
There we
play,
go.
now you see it, now you don't. How about that?
Okay, there we go.
That's not gonna work, so. I click on it, so go back, all right, I gotta use the mouse here, so. Thanks for coming to learn a bit about Potlatch Deltic today. I think we're a pretty compelling investment opportunity. I'm Jerry Richards, CFO, been with the company for 9 years. I've been in the industry my whole life, literally. I grew up in the timber town. So with me today is Wayne Lacecheck. We're gonna tag team this, and it's gonna look like he's gonna flop in and out and then in. It's not because we're going every other section. That wasn't the intent. It's just the way it played out. And what we're gonna talk about, I'll start by talking about the company and the industry overview. Wayne's gonna cover the timberlands and the real estate segments, because it's just kind of a look at how those are lined up in the presentation. I'll talk about wood products, which is a key business segment for us, and then I'll wrap up with capital allocation and a little bit about our balance sheet. So in terms of company and industry overview, you can see our footprint here on the map. We're about a $4 billion enterprise value company. Obviously, public equity value will ebb and flow. Even this year, we've been as high as $60 a share. Today, we're trading around 44, 43 bucks a share. And we'll talk a bit later about what's driving that perspective, and also how it factors into how we think about capital allocation. But, you know, this company was formed in North Idaho. That's the core of the root, 1903. So we've been in business for a long, long time. And this is this is the heritage of the company. And over time, you've seen us grow in different parts of the country. You know, first it was in Minnesota, and then, you know, down in the South, and currently the South is our biggest growth footprint. In fact, when you look at the two blue states, those are two brand new states for us as of September. So we just completed a merger, which I'll touch on a bit later, with a company called Catchmark. So we are now in some new timber markets down in the South. Overall, it's 2.2 million acres of timberland, and about 1.5 million of that is down in the South. Again, Idaho is the other core part of that holding. And we also manufacture wood products, 6 sawmills, which we'll touch on when we get to that business segment. And we also have an industrial grade plywood mill here in North Idaho. We'll go through each of these business segments. I think in the interest of time, I'll get to kind of our core strategy. And when we think about marketing ourselves to shareholders, why are we different? You know, so when you think about it, you as shareholders out there have options into where they go invest their dollars. And we want to make sure that we're a better, more compelling investment opportunity than others. So this is one of the core differences in our company versus our direct timber peer set. And we pride ourselves when we go to market, as being the most leveraged to lumber price. And we use this chart to depict what that means. And for every dollar of EBITDA that we generate, about 2/3 of it is directly exposed to lumber. So when you think about it, sawmills producing lumber and shipping. So whatever the profits are in those mills, pretty clean, right? I mean, that's lumber EBITDA. But we also do something that nobody else does. And you can see that on this chart. It's depicted in the green. And we index the price of about 75% of our saw logs in Idaho to the price of lumber in a 1-month lag. So kind of double down on that exposure to lumber. Wayne will touch on that a little bit later when he goes through the timberland segment, so I won't go into a lot of the details. And you can again see nobody else does that. And then you also have 2 distinct strategies that are different. So you have an integrated model like us. So we're in the manufacturing business as well as timberland. So you can see that with Weyerhaeuser as well. And then Rayonier, and Catchmark actually no longer exists. Catchmark is now part of our bar. So it's the company we merged with. So Rayonier is a pure play timberland owner. They have 0 manufacturing. Obviously, lumber is volatile. So as an investor, some people have concerns about lumber prices can be high or they can be lower. And you can see that volatility on this slide. And we've been as high as $1,300, $1,600 per 1,000 board feet, which is well above anything this industry has ever done in the past. So just blowout pricing. Now we think we're kind of past that window, and we'll touch more about why we think we're settling into a more normal, longer term price range here in a little bit. Backdrop for housing. So again, this is all about that leverage to lumber. Why does that make sense? I think that strategy is best aligned with the housing fundamentals, which remain really positive. And we'll touch on affordability issues and mortgage rates and things. So hold that thought. We'll lay the whole picture out here. But it kind of starts with this underbuilding that's happened over, since the great financial crisis occurred. Part of the issue that spurred the great financial crisis was overbuilding in housing. And then you obviously had mortgage-backed securities and some other issues, that really kind of set off that crisis. But that quickly got, the housing inventory backlog quickly was sorted through. And then ever since the great financial crisis occurred, you've seen this steady underbuilding over time. That's what's depicted in the green side of this chart. So, we had really strong home demand. In fact, home builders couldn't build houses fast enough. We couldn't deliver lumber fast enough. And that's why prices ran as high as they did. But that underbuilding still exists. You don't have as many people looking for houses today because they can't afford them between the interest rates and the and the prices. We think that's going to correct over time. The fundamental key here is there's still a shortage of housing. That hasn't changed. The other thing that is still a positive tailwind from a housing fundamental standpoint is demographics are on our side. And there's kind of an interesting comparison to the lead up to the great financial crisis. You can see there was a dip in this prime home buying years depicted in the green line. And where we find ourselves today is there's actually a peak. So the millennials, largest demographic cohort in US history, are in the prime home buying years. They're still out there, still need housing, still like to buy something, probably can't afford it as much today, but they haven't gone anywhere. So when you get to the affordability issue, that's what this chart depicts. So you can see the spike in interest rates, and that's really hurt affordability. This chart's a little stale. It's actually gone up about 6% as we sit here today, or above. And the affordability certainly has gone down. Now, we're certainly in a mode where the Fed is tightening. In fact, they just announced another 75 basis point increase yesterday. They're not done. It's clear. There's going to be some more increases, and that's going to continue to slow down housing. But we think we'll get to a point where conditions improve, and they'll have to start going to easing cycle and start reducing rates. And when that happens, then we also think home prices are going to correct down, which those are both positive factors that change this dynamic. So again, we're still in an underbuilt situation. We still have the millennial demographic cohort still out there. Homes become more affordable. Demand picks back up. You look at the age of housing, where this is important. Most people don't realize that there's actually more lumber that goes into repairing and remodeling homes than there is building homes. About 40% of overall lumber demand in North America, whereas building homes is around 35% or so. So this is important. What happens when you have an old home? It's smaller. At some point, it needs to be repaired. You got COVID, schooling from home or working from home, want more space. Remote work is not going anywhere. In fact, I read a stat, I think it's somewhere between 30 and 40% of the workforce is still working from home. That also creates the opportunity to go live in a lower cost area. So there's a lot of factors here that, these older homes are actually very positive for lumber demand as well. Consequently, you've seen residential improvement spend has been increasing over time. Now, we had a nice spike, during COVID. In fact, that was one of the first things after COVID hit and everybody was at home. All of a sudden, Home Depot was packed, right? They had to stand in line because they were limiting the number of people in the store. But, they were really tight on inventory, lumber inventory included. We think that's going to normalize, but still on a nice growth trend over time. And that's back to the age of housing stock is a key factor. Amongst consumer confidence, strong personal balance sheets, job market's good. Those are all key variables at play in this as well. And then I'll touch on there's new growth and demand, and this is but one example for us. Cross-laminated timber, CLT, is one of the buzzwords of many that you'll hear. And there's actually been some of this has been constructed here in Spokane as well. And you see a nice wood in this building. That's not CLT, but you see a lot of use of wood. So that's definitely a demand growth for us. And what's happened is you can now build a wood building 18 stories high. Building codes have been changed. And what you have is a bunch of lumber that goes in a factory setting. And we actually have one of these factories in Spokane as well, out in the valley. But you lay and you cross-laminate this basically lumber and you glue it together. And depending on the strength characteristics determines how many layers of lumber and how much strength you create. So we think this could be a nice bump, and meaningful bump in lumber demand over time. Last but not least, just talk a bit about, this chart's a little stale. I don't think, you'll see capacity ratios in the high 80s, low 90% range, with slowing in housing. That's certainly come down a bit. But we have a situation where British Columbia has the highest cash manufacturing costs of any region on North America. They represent about 15% of US supply. So if you need them to stay in the game, that effectively creates a price floor. So we do think lumber prices are going to stay above kind of long-term averages, even though housing has slowed down here. And we're certainly seeing that today, where lumber prices were dropping a good part of the year, and they settled out around $500 per thousand board feet. You might say, is that good? Do I like that or do I not? Long-term average about $375 per thousand board feet. So, and about the time you started approaching 500, you started hearing market curtailment announcements, primarily from Canadians. So the price floor, still works and is still in place. So I'm going to hand it to Wayne.
Thanks, Jerry. So we'll dive a little deeper into, we're really into three business segments. So as Jerry mentioned, timberlands, wood products, and real estate. So kind of cover our first business segment with timberlands. We have 2.2 million in high quality timberlands, 7 states. So here in Idaho, we're the largest private landowner, and 626,000 acres in 6 states in the South. As Jerry mentioned, we just completed acquisition of Catchmark, 2 new southern states, 2 markets that we hadn't been in before. So Georgia and South Carolina, high quality, more market tension in those states and those markets. So really a great acquisition for us. Now, if you look, total 2.2 million this year alone, we've experienced our most growth has been in the timberlands business. So we've acquired about 450,000 acres in less than a year. And that, primarily kicked off last December. We acquired another timberlands looter acquisition, about 51,000 high quality acres in Arkansas and northern Louisiana. And that was about 100 million cash deal, tax-free cash deal. And then during the year, we've also acquired another about 46,000 acres in the South. Those have been cash deals in mostly Mississippi, Alabama, and Arkansas. And then finally, just completed middle of September, 350,000 acres, Catchmark. That's about over an $800 million deal. So we've deployed about over $1 billion in capital in less than a year in timberlands, mostly through equity, and as like I mentioned, about 100 million in cash. So pretty active in this space, and it's been really adds to our profile here. So one of the key points I think with our timberlands business we think about is sustainability, and that it's also financially, but also how we manage the business, right? So you think of it's a long-term business cycle with timberlands, right? You think about planting a tree, the growth, and then the ultimate harvest, right? For Idaho, trees grow slower, so that whole cycle is probably 40 to 50 years before you harvest a tree. So you think about harvesting, and then we replant about a year and a half after harvest. Each year we plant over 23 million seedlings to replenish the harvest that we've completed in the previous year and a half. In the South, it's a much shorter growing cycle. Much more big trees grow year round in the South, so it's probably in the neighborhood of around 25 years. You have more moisture and growth activity compared to Idaho. And I think another important factor is we manage that on a sustainable basis, through sustainable forest practices. 100% of our management is SFI certified, so that's a sustainable forestry initiative. How we manage our timberlands. And then I think the other point there is on harvest activity. So a little under 4%. So it's a sustainable basis. It's reoccurring. It's you're not going to harvest all your trees in one year, right? It's well planned, thought out. We manage it. We have a harvest plan that's 50 years out, and we look, what are we going to harvest in the coming years, and manage that accordingly. So, and then also, Jerry a little bit later will talk about capital allocation, but that goes into how we sustainably manage our timberlands business, and that also ties into a sustainable dividend that we provide. Jerry touched on Idaho. It's very unique to the industry. No one else has it. We're indexed to price of lumber in Idaho, and that's, you can see that graph there ties into some of the previous graphs that Jerry showed on lumber pricing, right? So, most recently with the huge spike in lumber pricing, during COVID, demand was way up. Well, that ties into where we're leveraged with lumber. So not only on the lumber side, but we're leveraged and indexed here in Idaho. So we saw, fantastic performance from our Idaho business with this leveraged model. So we leverage our saw logs, which over 95% of the harvest in Idaho is saw logs, and probably, the agreements that we're under on a 5-year rolling average, so evergreen contracts. We talk about productivity in Idaho. I mean, you compare it to, say, Oregon, Washington. Idaho outperforms those regions, just given the climate, the growth cycles there. Yeah, it's really in the mix. We've got cedar, Doug fir, some really high quality timberlands. Jerry will touch on wood product segment, but we mentioned we have a mill in northern Idaho, so we sell logs. Both our timberlands business both supplies logs to our internal mills, but then also sells to third parties. So it goes into that integrated model that we have. Thinking about the South, we're really, especially kind of our legacy potlatch business, we're really hedged in the U.S. South. So somewhat agnostic to price changes, because we have 3 sawmills in Arkansas, so they consume about 200 million tons of logs. On the flip side, our timberlands business sells 2 million worth of tons of logs. So as prices go up, we receive more on the timberland side. We pay a little more on the wood product side, or vice versa. So we're really hedged well in the South. Now that'll shift a little bit with our acquisition Catchmark. So we'll have more kind of in the kind of Southeast region. This is really more focused kind of on our Gulf South business, where we're really hedged. I think the other factor in the South is, trend pricing in the South has been low for an extended period of time. So you've had, really, and what's driven that is, probably over 30 years ago, there were incentives provided from the government to plant timberlands versus crops. Really was an initiative to control erosion, prop up crop prices. And so there was a big incentive. There was a lot of plantations developed around forests. Also combine that with silviculture practices, really have an exceeding supply of timber in the South, right? And that has outpaced demand. So in typical supply and demand, you have more supply than demand. It really has driven, kept prices extremely low in the South, compared to where, what we see in, say, for example, Idaho. Now, that trend could be shifting. I think, we've said for some time, lower for longer in the South. What we've seen, that consistent low pricing in the South. Is that starting? We've seen some upticks in Southern pricing. Is that really a trend that's going to shift? Maybe we'll see how that plays out. But no doubt there is tension becoming, tension in the markets that's coming along, right? So the South has an enormous supply of logs, so that's attracted more investment in manufacturing, both existing mills adding capacity, like us, Jerry will touch on, but also new greenfield mills have also come to the South. So you have, because you have such a supply, cheap logs, there's a lot of incentives for mill expansion down south, and we're seeing that. So, almost over 4 billion board feet coming into the market. Some already there, some expected to be coming. So really, you could see more tensioning in the south, which will, drive up pricing. And this is just another demonstration of pricing down south, kind of growth versus drain. So growth has far exceeded the drain, or harvesting of blocks, and that's forecasted to shift over time. With this tensioning in the markets and demand that we expect in the future. And we also talk about climate change. How could that impact our business? One, that's important that we diversify. So we continue to diversify our portfolio. Catchmark has done that for us, diversifying into other markets in the south. We have timberlands in the north, the south. So the more we can diversify, I think that's better. As potential changes from climate, we think that could be a positive factor down south. On growth demands as we continue to study that. And then the final piece, this is just EBITDA that we've experienced over the last couple of years. Probably the one point here is, dark green is Idaho, light green is the South. Southern EBITDA has grown just given our footprint and our acquisition history. And then as it relates to Idaho, you can see really the impact of indexing. So, when you think about 30% of our volume is Idaho, but probably 60+% of EBITDA is generated in Idaho. And it's really that indexing arrangement that really is powerful coming through in our results. So I'll turn it over to Jerry to talk about wood products.
Okay. So in terms of wood products, second of our three business segments, in the right direction here. So you see a similar map, and now we're looking at capacities by mill. So this lists each of our mills. The map kind of depicts where they are located in the U.S. We're a 100% U.S. based company, and we're a top 10 lumber manufacturer. So the first 6 facilities there are sawmills, aggregating almost 1.1 billion board feet of volume per year. Then I mentioned in my introductory comments the industrial grade plywood mill that sits in St. Mary's, Idaho as well. In terms of when you think about running this business, it's a commodity business. So being a low cost producer is vitally important here. So we regularly invest capital in this business. There's obviously a base level of maintenance capital we got to invest, but then we're also looking at return projects as well as growing capacity. And you think about it, you got inflation headwind you're facing, bigger headwind these days than typical, but normally you have kind of that inflation headwind. And reducing costs, increasing production capacity is the way you continue to, increase the net real profitability of these operations over time. You look at it, our track record is really good here. So if you go back using 2015 as the baseline, it's before we did our Deltic merger, which added 2 mills. We're at 4 sawmills, about 600 million board feet. And like I said, today we're at 6 sawmills at 1.1 billion board feet. Good chunk of that growth was 2 mills we added in that Deltic merger in 2018 is when we closed that deal. That was about a 1.5 billion acquisition, all stock deal, with some debt assumption. But we picked up 2 really good mills here that we've got actually invested, made them even better since that merger. So you look overall, it's about a 2.5% organic CAGR, compound annual growth rate. Like I said, it kind of comes in fits and starts. I'll come back to that thought on growth, and I'll give you some examples or things that we're thinking about doing going forward. So overall, kind of picture here for this business, it's about a 60 billion board foot lumber market in North America. You can see the pie chart on the left depicts, where the volume is manufactured by region. I touched on a little earlier that, Canada has some challenges. You kind of see a bit of that depicted on the right-hand side, where the share of the U.S. market has dropped. And fundamentally what the issue is, they're running out of trees. It started with mountain pine beetle, which decimated their lodgepole pine forest starting about 20 years ago. Had limited shelf life, you had to go in salvage, and that's kind of, they're behind that. They've had some massive forest fires. And the farther north you go on the continent, the longer it takes to grow a tree. So it'll take a long time for these forests to come back. Consequently, the harvest has gone down and their market share as lumber manufacturers have gone down. And the costs have gone up too. Shortage trees, supply and demand, basic factors are at play. So as you have fewer trees, you got to pay more for what's left. You probably have to go farther in the woods. You think about diesel and gas prices these days, but it's really diesel and a logging business. Your costs have gone up as well. So it's a pretty challenged business. And therefore, what you've seen, Wayne showed you some growth in the US South. That's the cheapest fiber in the free world. You know, Russia has cheaper fiber, but obviously with what's going on there, they've had challenges before, but you know, that fiber is not accessible to the market. And you've seen a decline in British Columbia, you know, over on the left-hand side of this chart, and it goes back to those factors I just touched on. The estimates are there's probably another 1 billion to 2 billion board feet of capacity that needs to come out of Canada permanently, just because we're running out of trees, cost structure, you know, mills are not as competitive. So that's part of the favorable tailwind. Going back to our belief in this leverage to lumber, integrated player, housing fundamentals, but we also have a situation where capacity is tight today. We saw that big time in the COVID window, and it's going to continue to stay tight because the industry can't replace these mills that are coming out fast enough. So that's another key part of that story here. Back to the theme of investing. So in June, we announced that we're going to modernize and expand our Waldo, Arkansas sawmills. This is one of the two we picked up in the merger that I mentioned just a bit ago. It's a $131 million project. You can see some of the other basic metrics. It's all available on the website. You know, the base case internal rate of return is about a 22% with a relatively conservative lumber price assumption embedded in that modeling. And that certainly could be a much higher return. And we've also modeled the down case, and it's not much worse, and we're still better than cost of capital here. So we're really excited about this project. The second mill we picked up in that merger, when I said it's getting better, it actually was a mill that, you know, it's probably a third or fourth quartile. You know, it's one that we certainly had our eye on, and we're working on improving it. And unfortunately had a fire in June of 2021. It burned a large log breakdown line, and fortunately that's all covered by insurance, including business interruption or lost profits. You know, so we are in the process of receiving between 90 and 100 million in insurance proceeds that will pay for the replacement of the equipment, as well as the lost profits with these high lumber prices we've seen. So we'll be made whole financially. Good news is this mill has been rebuilt. It started up on time here in the third quarter, and it's currently in its startup phase. And to put it in context, I'll give you one example of how this mill is better. You know, it always had been anticipated it was going to run at 150 million board feet per year. It was generally doing about 125 to 130. With this new equipment and rebuilt and some other changes we made, we think we have no doubt that we're going to get to that 150 million target. Some other examples, again, this is on the website. In the interest of time, I'm going to skip over that page. Guess what? ESG applies in the mills as well. You know, yeah, we're emitting, you know, carbon, you know, so it's definitely a negative. But you think about from an ESG standpoint, wood is a carbon vault. So when you think about a tree, you know, about 50% of a tree's weight is the woody mass. The rest is water. When you manufacture lumber, about 50% of the lumber is carbon, and that carbon is sequestered for the life of that product. So as long as these walls and this building stands, we got carbon sequestered in this room, for example. And if you have a house or a building last for 100 years, that's a good thing, because in the meantime, you've had multiple rotations in the forest. You know, that's the engine that sucks the carbon out of the air, and then you go put it in the bank, right, forming wood products. So it's a virtuous cycle. Now, having said all that, we are trying hard to minimize and reduce the amount of emissions we have in our mills over time, and we have focused targets here to continue to work on that over time. In terms of EBITDA, again, you got some high bars there. I tell you, the scales on these charts were nowhere near as high and as lofty as what you see here. But we've had some real strong profitability here in wood products over this run in COVID. And as I mentioned earlier, we think the business conditions are still good, you know, better than long-term averages, even with this weaker housing. So the business can hold it pretty well here. And then game on, you know, once we get more affordable housing and demand picks back up, and then we get to another level of performance.
So then our third segment is real estate. So really there's two main pillars in a real estate business, one being called rural real estate sales, and then the second being development. So rural sales is, you know, really the mission there is for us to sell identified timberland at a premium to timberland value. So, we look at, 4 or 5, typically multiples on rural real estate sales compared to what we could do as managing it over the long term as timberlands. And then we take that capital and recycle it back into the business, purchasing more timberlands or other high value returning projects. That's a continuous cycle of selling and buying. And really, we have a wide range of customers or targets in that sales markets. It could be conservation purposes, recreational purposes, government entities, touch on solar, so green energy. So there's really a lot of really identified third parties that we sell rural land to. And, we go through, with our recent Catchmark transaction, we're in the process of going through what we call a stratification process. So really looking at acquired timberlands, what are the opportunities that we can have there to really sell certain pieces at a premium. And that could be either, it's tied into, maybe closer to a development, higher urban areas, easy to tap into the grid from a green energy standpoint. A lot of different attributes that we look at to identify really high value timberland. And these are, I won't go in detail, but this is just some of the examples where we really had some great success in conservation sales, most notably in Minnesota. We completed one, for example, sold over 72,000 acres in Minnesota for about 48 million. So it's really a kind of long-term strategy we had to really exit Minnesota timberlands, and that really completed with that sale in 2020. I think the other thing to mention that's really come up more recently is opportunities in green energy and solar. We've identified, potentially anywhere between 50 and 100 million, and I think that'll go up with, identifying more opportunities with the Catchmark plans that we have. But green energy opportunities, we even this year completed a transaction for over 13 million in EBITDA. Price was well over 7,000 an acre. It's, really perfectly situated for solar farms. So. Second piece of real estate is the development activity. So Jerry mentioned Deltic merger that we did back in 2018. Well, Deltic had a master plan community that's started about over 30 years ago in the late 80s. It was about 6,000 acres of timberland that they developed into a residential community just outside of Little Rock, Arkansas. So when we purchased Deltic, we assumed this development business. Really kind of two pieces to that, residential and commercial sales. So most of the infrastructure is in place for this community, and then we continue to build out different pockets within that community. Really all we do is go in and add the infrastructure. So water, utilities, and then roads, gutters, and we sell lots to commercial builders to build residential homes. On average, we probably do about 150 lot sales a year, averaging anywhere between $80,000 to $100,000 per lot. And then we also, will have a handful of commercial sales during each year as well. That tends to be more lumpy. But yeah, those are kind of the two components for a development business down overall. And so you can see from a real estate business, it's a lot more lumpy. You can have a big sale. So I mentioned in 2020 that large transaction in Minnesota. So you can see outsized performance in 2020. Each year can be impacted by one significant transaction. We tend to have a pretty steady level of same store kind of sales, real estate sales, and then on top of that, we can have some larger transactions. So.
All right, last but not least, but a really important area, capital allocation. So we talked about generating a lot of capital. Now, what do we do with it? So capital allocation is a fancy way of talking about how you deploy it and invest it. So couple of important things on this slide. This kind of tries to capture our overall capital allocation strategy on one page. And if you think about the horizontal, the green and the blue series of arrows, we go back to we're leveraged to lumber. There's a volatile element of our cash flows. Our financial commitment should not be based on the volatile elements. It should be based on the stable, which is really what the green is. So green, think timberlands. In terms of stable cash flows, take out the indexing, but there's a base level of cash you're going to generate timberlands year in and year out. And that really is focused. That's what the regular dividend is based upon. We're going to grow that dividend sustainably. We have a really good track record. I'll cover here in another page here in a bit. And maintenance CapEx. So think about maintaining our mills. Think about building those lots to sell that Wayne talked about to sustain that business. Those are our financial commitments, and we don't ever want to get over our skis. Want to make sure that we can rely on the stable cash flows to meet those commitments. Now, the variable cash flow, we've had a lot of variable cash flow the last few years, as you've seen. Piled up a lot of cash. That's a discretionary cash. That's where we're going to make some decisions on what is the best use and deployment. And the menu set is off here on the right. It could either be share repurchases, special dividends, discretionary CapEx, or buying things, M&A, mergers and acquisitions, which have been active there as well. So we'll touch on these menu items later. The other thing I will talk about here, I want to make sure we touch on, is the first mission before you get to the discretionary is maintaining a strong balance sheet. And we have a philosophy that maintaining a bulletproof balance sheet maintains flexibility and optionality. So when things are not good, that's usually when the big opportunities occur. We want to be able to make sure we can act. And I'll give you a couple of examples. When COVID first hit, financial and lumber markets all panicked. 40% of lumber capacity was shuttered. We had a large market cap in our space, actually proactively drew on the revolver. They're worried about liquidity. They suspended the dividend. They were buttoning down the hatches. Here comes the storm. Other than, looking around and saying, no, we're good, because we had a strong balance sheet, what do? We went and bought shares at below $30 a share because we felt like that was a really good, use of capital in that case. So that's back to the strong balance sheet. That's mission one. And then you get to the discretionary. That's how we think about this page. So let's go through some of these components. So this is all about returning cash to shareholders. This main chart here is a regular dividend. You can see we've increased the regular dividend on a per share basis 42% since 2012. That included a 7% increase last year. And with our accretive acquisitions that we've done, that Wayne touched on earlier, I think shareholders are fully expecting that there'll be another regular dividend increase in the fourth quarter of this year. Last year we paid a $4 special dividend. It's not depicted directly on this slide. It's kind of embedded in this 90% payout on the bottom. That special dividend, we don't like special dividends per se. That was really to protect our REIT status. So there are limits on how much cash we can generate in our sawmill business and hold. I never believed that was the case until we got to $1,600 lumber, and guess what? There is a limit. So the fix for that is you distribute that to shareholders. So that was a big part of why we did the $4 per share special dividend. Now shareholders, I think, are excited because there's another special dividend coming this year because we've had really strong earnings and profitability again this year and generated cash. And we've said publicly that's probably more like $1 a share rather than the $4 that we did last year. And then last but not least, I think we set a record between the CEO and I. A number of times we talked about share repurchase, mentioned it on our earnings call we just had last week. And when you think about it, I touched on it earlier, where public equity markets have pushed our stock price down to around 43 a share. That's well below what this company is worth. And we tend to be value investors when it comes to purchasing shares. What does that mean? We see a deep discount. So in my day, it was Kmart had a blue light special, but think deep discount, big fire sale. That's kind of where stock's at today. So with a strong balance sheet and a lot of cash sitting there, we think a good use of that capital is it's a good time to go buy shares. So we just put a $200 million authorization in place at the end of August. And the market, we were able to start trading and buying our shares again in November. We've been blacked out a large part of this year because it's merger, but we're kind of back in the game now. In terms of capital expenditures, I really touched on this earlier and some of the examples of what we're doing and how important it is. But you can see, we're investing pretty heavily in organic growth in this business. A good chunk. The green is wood products, so that'll ebb and flow, based on the return opportunities that we see. Certainly that's going to remain elevated with the Waldo modernization expansion I talked about, the $131 million project. And then you look at and you say timberline's the next key piece, that's replanting largely. So that's maintenance, so when we harvest, as Wayne said, we replant within a year and a half. And then there's also the real estate piece at the very top. The dashed line shows you maintenance capital. We think that's around 40 million a year for the company. With kind of the discretionary and the piece that's above maintenance largely driven by wood products. So I think the green portion, on that line. The balance sheet, like I said, is really strong, bulletproof. We got, in this case, 511 million in cash. This is last quarter's IR deck, 484 million at the end of September. We did refinance some, we assumed and refinanced about 300 million of catchmark debt. We actually, believe it or not, took our interest rate down from 3.1% weighted average for the company down to 2.4%. Even though rates are skyrocketing, you ask, how do you do that? Back to being opportunistic and thinking about creating shareholder value. We did a forward interest rate swap trade in March of 2020, back to when the world was panicking. So not only were we buying shares, but we did a 654 million notional trade that at its peak has been worth over 120 million or so, assets sitting on our balance sheet, which effectively what we did is we locked in future refinance rates. So we were able to deploy some of those swaps. And on this 300 million of debt, we achieved interest rates of 1.8% when market rates are probably more like 5 to 6%. You can see the overall EBITDA history. We kind of touched on this. Again, I touched on ESG a little bit. I mean, this certainly is a key part of our story. When you're in the business of growing trees sustainably, and it's got to be part of the climate solution, given the carbon they sequester, and I talked about the carbon vault. That environmental side is a really big part of the story. I would estimate that probably a third of our shareholders today have an ESG focus in the company, and that's grown over the last 2 to 3 years. And I expect that trend will continue. And then certainly social and governance are important as well. You can see in terms of total shareholder return, this is benchmarked, we're the green bar. So the place you want to be on this chart, obviously it up that's, higher than anybody else is good. So we've outperformed different indices, whether it's NAREIT, S&P 500 in total, or a peer group, which is down here in the lighter tan. So we've had a good strong run in performance. So with that, why don't we open it up to Q&A?
Don't be bashful, guys. Go ahead and ask your questions. This is your moment.
And people online will be able to ask as well,
Yeah.
right? So
Yeah, if you're online, please go ahead and just unmute yourself. You can also use the chat feature if you'd like.
yes,
You have timberlands all across the US,
yes.
Northwest Minnesota, right? And then Southeast. Is there a different allocation for the different wood products, right? Like the South being pulp versus the Northern being structural, something along those lines?
I'll let Wayne take that one. That's touching on timberlands.
Yeah, there is. So if you look at Idaho, for example, probably about 95% of the volume there is saw logs. So when you think of kind of two buckets, timberlands, right, saw logs and pulpwoods, saw logs tend to be higher value. So Idaho is about 95%. If you look at generally across the South, we're around probably 55% saw logs with the other remaining portion of pulp. So yeah, so there's definitely a distinction.
Is that distinction what generates such a large disparity in earnings between, just those timberlands in Idaho and the timberlands in the South?
That's part of it, but mostly the indexing that we talked about, right, is really probably a bigger factor, but certainly the mix of saw logs is also a piece of it as well.
When you guys are selling your product, do you include transportation costs to the person? So that is with the crunch on diesel that's coming, transportation is going to be rather large, both from harvesting to your mills and then from mills to customer.
Right.
So you include you pay for the shipping to customers.
So let me take it in pieces because it's a little different between the log and haul side. So think cutting down trees and hauling to the mills, given part of your question, and I'm going to deal with manufactured products going to market as well separately. So on the log and haul, we report, so there's what we report and then there's our P&L. So what we report is on a delivered basis. So that would include your logging and hauling costs, and that actually is our largest cost line item on our timberlands P&L. And it's even larger now, to your point, because diesel is up significantly. And I want to say, you know, that cost upper for us, just a variance, is probably a 16 million increase for the year relative to what we expected when we budgeted last year at this time. So delivered basis, so the mill customer typically pays for the delivered log, right? Because part of the service is getting it to them. So they would typically end up bearing, you know, the freight. Now, when we're delivering to our own mill, we as a company are bearing that cost. And then on the shipping side, we typically arrange the freight, and then it's basically a net wash for us, because you'll see it in a revenue line, but also there's an offsetting cost, and we're just passing that cost through mostly.
So with those rising costs for diesel fuel and the you know, the ESG focus of the company, is there like a look into more sustainable green solutions for resolving that cost, like electric vehicles or something maybe?
Yeah, it's a great question. And again, ESG is really important, you know, to our investors, but us as a company. And, you know, there's where we can, we're certainly looking at that. So for example, we have a bunch of forklifts running around our mills, you know, moving lumber around, you know, from various manufacturing stages or loading trucks. So we're looking at electrifying all of our forklifts, for example. Now, when you think about, you know, all of the trucks that we talk about, we don't have any company-owned trucking, you know, whether that's on the log and haul side, that's all contracted out. And then on the shipping side, we're not in the trucking business, at least today. And I would never thought that we would start talking about, because back in the day, you used to have company loggers and haulers and truckers. And then the industry, for the most part, has outsourced those activities. But now when you think about labor shortage, truck driver shortage, you know, all these other issues, you know, maybe at some point we do get back into some aspect of company log and haul. Yes.
You said like Catchmark diversified you guys in the south. How did it diversify?
Yeah, so when you look at it, I mean, Wayne showed one slide that talked about this natural hedge and the oversupply and the effect it's had on keeping prices down, which kind of goes back to an earlier question here as well, the difference between region. You know, and Catchmark actually operates in some of the strongest pricing markets in the U.S. South. And I'll give you an example. On a you know, on a pulpwood basis, so a low value product, I'm going to do it on a stumpage, not on a delivered basis. So I'll always advertise that, because you can get, you know, the numbers can get confusing if I don't. But pulpwood for Catchmark markets is around $15 a ton. Again, that's net, that doesn't include log and haul. And in our legacy markets, more like $5 a ton, just to give you an example. So selling for 3 times the price. Why is that? Wayne showed you a chart in the Gulf South where mills are coming in. Guess what? That's already happened to a large degree and in a much bigger way over in Georgia and South Carolina. So therefore, those wood baskets are way more tensioned, and the price, you know, the demand supply dynamics are in a different place. So, you know, so we got stronger pricing markets, but also just geography. I'll give you another example. Just before I joined the company as CFO, you know, we had a large log customer, CrossFit Plywood Mill, Georgia Pacific Mill, closed in Arkansas. And that was a big customer. I want to say it was probably 800,000 tons or so, you know, a year is what that mill consumed. And it had an outsized effect on our P&L. Consequently, the company actually had to cut its dividend as a result. Being in more wood baskets diversifies you. You're not as affected by one customer, you know, or one mill is that case. Now it's an extreme case, but that's part of depicting that diversification.
Do you want to have another mill in the Catchmark territory?
It's a great question. I got a ringer in the back here, so
Sorry.
that's all right. Jim and I go back, by the way, because he used to cover the company, and you know, we talk regularly. So it's a good question, actually. So one of the things that acquiring Catchmark in these new markets does, it opens up the opportunity set for future growth in this company. Now I'll give you a couple of examples. I'll come back to Jim's question specifically here, but you know, typically, you know, a forester can manage about 50,000 acres. And then you buy another 50,000, you need a second forester. It's kind of how that works. So if we're not in a state, and we're never going to look at a 10,000 acre acquisition, right? Because not only using 20% of a person's capability, right? So you got to have scale to start with. So Catchmark did that for us in 2 brand new states. They gave us scale. And I think the stat is Georgia, if I remember right, it's like 218,000 acres. We got scale there, and it's pretty concentrated. So now that 10,000 acre opportunity comes up and it fits, we'll look at it because we already have that infrastructure in place. And we do like the integrated model, and we do want to grow it over time. But we've always said we would never buy a mill unless it were attached to our trees, either like Deltic, it came with trees, or it was a mill that was already in our timberlands footprint. So being in the Catchmark markets now opens up that opportunity to think about, potentially acquiring or building a mill, which we would have never done that prior to the acquisition.
You're just speaking about acquiring chunks of, essentially chunks of land that could be somewhat associated to a mill or a locality that you already have a space in. Is M&A of acquisitions of companies, is that a primary growth strategy for you guys to keep expanding outward into other timber territories, looking for something similar to Catchmark or any of these other companies?
Yeah, so I'll talk about growth broadly. So one of the things to, I want to make sure it's clear to folks is, we're only growing when it creates shareholder value. I mean, that's really ultimately when you step back and you think about our capital allocation strategy. What do I mean by grow shareholder value? It means that every share is worth more tomorrow than it was yesterday. That's growing shareholder value. Putting cash in their pockets counts as growing shareholder value, as well. So if we can buy something and add value, create value, and how do we do that? When we talk about Catchmark. So Catchmark was the smallest market cap in our space. It was about an $800 million company, enterprise value that as Wayne mentioned. But yet they have an SG&A load that's not too much less than us, even though they're much smaller than PotlatchDeltic. So you think about that, back to my forester example, they got foresters that are managing 10,000 acres. I'm using it by analogy in the SG&A space, right? So, when we do the merger, we don't need 2 boards, we don't need 2 CEOs, we don't need 2 CFOs on down. So they had probably, a 10 to 15 million SG&A run rate per year. And at the end of the day, we'll drop that down to 2 million. So that's creating value because you're getting rid of costs overall in a combined company that you don't need to manage the same set of assets. So that would be an example. Now it's relative to the price you pay, right? Because you can overpay to get those benefits. So it all has to hold together. But if we can create shareholder value, we're going to continue to grow the company. And as Wayne said, we've deployed over $1 billion of capital since December and had a phenomenal run here, mostly on the timberland side, on the wood product side as well. Here more recently, prices of timberlands continue to go up. So we had a run where I think we won 8 bids in a row going back to last December on timberlands. We finally lost some deals. We were not the winning bidder here, and that's not the worst thing in the world. And we've seen timberland prices on a per acre basis are up about 30% versus what we're willing to pay today. So the market has continued to march forward. We own 2.2 million acres. The company's higher, if you believe in those private timberland market values. And back to buying our shares, our trees are on sale, right? They're on this Blue Light special sale that I mentioned. So again, we'll ebb and flow in our capital allocation priorities depending upon where we think it can create the most shareholder value. Today, it's buying our trees through a share repurchase. In the future, we'll get back to buying and growing the company.
But and probably a further point to what Jerry just said, if you think about, for example, when we acquired Deltic, our share price was it was over 50, right? So buying when our stock is highly valued, right? And then you fast forward to Catchmark, when we did that deal, our share price again was, around 55. And then, here we sit, low 40s. So then, we really deployed capital at a high stock price and acquiring timberlands at, a good value. And then, using our currency of stock. And then now here we sit at, in the 40s, and now, we pivot. And, as Sherry said, we look at share repurchases. So really, it kind of depends where we're at in the cycle.
It's a great point.
What is the reason do you think your stock is taking depressed at this moment?
Yeah, I mean, it's straightforward. I mean, people are concerned about the economy, concerned about inflation, recession, housing. And it's not atypical. I mean, they're around this business I've been around this business for 30 years, this industry. And, it's kind of the normal playbook. And shareholders will often ask me, hey, you're down significantly. Does that bother you? It doesn't bother me. It's time to go buy shares. You know, my job is to walk in the office every day and sit down and say, okay, what hand are we dealt? What should we be doing to grow shareholder value at the end of the day? I don't control where stock price does. I know what the company's worth. It's worth a lot more. I have a pile of cash and I see something that's on sale, I go buy it. And we're buying shares. So I'm gonna shift over here. We're gonna give him a break here.
Absolutely. Yeah, so has any of the like adverse weather events in Florida and kind of on the East Coast affected your guys' operations in the states?
Yeah, short answer is no. A lot of our timberlands are fairly well inland. So, you know, a few years ago, we had a major hurricane come up through like Texas, Louisiana. By the time it got to Arkansas, it pretty well petered out. So very limited damage. You know, what you hear about in Florida, we own nothing in Florida. So that's usually, you know, by the time it gets up to South Carolina or places like the last hurricane went out to sea and it kind of came back. They didn't have any damage to speak of there as well. Biggest risk we think about natural disasters actually fire in Idaho. You know, out west, you know, obviously fires are a big headline. You know, I could go through, we could have an hour conversation on what our team does to mitigate that risk, but feel really good about what our team's doing to mitigate that risk.
Talk about your harvest, you know, the two big peaks here, lumber pricing. How much optionality do you have to either accelerate, whether on or off the harvest of traditional versus your scheduled 50-year plan?
Yeah, I mean, the most we can flex in a year is up or down about 5 to 10%. You know, there's a host of factors for that. I mean, one, it's a long-term process to plan and schedule it. You know, there's limited log and haul capacity. That's actually a challenge. So it's not like you can log and haul capacity. So the contractors. So it's not like you can surge significantly, take advantage. And then the other thing is, you know, we manage the forest sustainably. You know, so, you know, Idaho is a tight wood basket in particular. So, you know, we're gonna harvest on a sustainable basis year in and year out, and you know, it served us well. You know, in terms of profitability, and kind of hard to play that game.
Yeah, no, I get it.
I don't know really much about the timber industry. By much, I mean zero. Do you guys attempt to maintain price levels at all, or do you follow the swings of the broader commodity index? Do you just, when it's high, you're selling high, when it's low, you're selling low? Do you attempt to smooth?
Yeah, if we had a way to control pricing, we'd be having an antitrust conversation.
Or do you,
It's
will
a-
you take lower margins when,
Yeah,
or do you maintain your spread?
yeah, in a commodity business, you really can't control the price. You really take what the market gives you. Now, I will say that we have on the 11th floor of our building down below us, we got a trading desk, and they're trading 1.1 billion worth of lumber a year. And every day they're in the market and they have a good sense. I think our team does a really good job of incrementally outperforming marginally on a regular basis. Pretty good insight and feel on where the markets are going. You know, do we increase the length of our order files or do we shrink them? You know, and you can only play that game within a certain window. You know, you can have from probably 1 to 4 weeks, maybe 6 weeks in an extreme, as an example, but we've got a really good team that I think does better than average. But we're price takers, not price makers.
Make sure online, is there anybody who has a question? Feel free to use the chat or just unmute yourself. Any questions from people on Zoom? Okay, let's keep going.
In your manufacturing, whether it's the specialized equipment you need in your mills or any of your transportation pieces, is there exposure to outside the US suppliers that could potentially create a hiccup if there was any global event?
Why don't you take that one? You're like, thanks.
Yeah, I think just like most companies, especially recently, supply chain issues, right? Certainly, you think especially in our manufacturing facilities, repair and maintenance and so forth. So we've been we've been very proactive and, hey, do we have enough spare parts? Have we thought about critical parts, breakdowns, trying to manage that cycle from a supply chain standpoint. I would also say that, Jerry talked about the mill upgrade at Waldo. We've partnered with a really good company that has, delivers on time, quality products. So, and we feel very comfortable about, hitting the timeline and no impacts from supply chain issues or, outside forces like that. And I think, from a market standpoint, we pretty much sell just to the North American market here in the US. So it's not as impacted from, internationally. Now, what I would say is there can be some impacts, globally where, say take, for example, recently with Russia, all the conflict there, they were a lot of the wood out of Russia, going into the European markets, right? Well, that's obviously contracted, extremely. And so then that means, potentially less wood being exported, from Europe into the US. So, that really can have an impact to where, maintaining pricing in the US and maintaining the markets here. So there can be, those impacts global.
A question from online. What are your biggest competitive advantages versus your competitors?
It's a really good question, whoever asked that online. So biggest competitive advantages, you think about it, again, we're in commodity markets. It's not a high-tech business, most of your inputs are available to everybody. So how do we win at the end of the day is another way I'll take that. Well, it starts with, capital allocation. It starts and ends with that. So where are we investing the capital? Are we making the right decisions? You got to take a view on long-term markets, for example. You got to take a view on long-term opportunities and risks. So to the degree you can have a better crystal ball and make those types of bets, you can get a competitive advantage. Not really, at the crux of the question, but the interest rate swap trade I talked about earlier, nobody else did that trade across corporate America. I think we're the only company I know of that did a big interest rate swap trade and locked in future refinance rates. And that was all the way out to 2029, by the way. So it was a big, unusual trade that paid off big time. So there's an example of creating competitive advantage. And it's the quality people you have, and it's the culture you have, are ways that you could win as well. Because at the end of the day, you can have the best set of trees, and you have the best set of mills. You have the great people that are motivated and driven and competitive, to run those mills well or to manage the forest effectively. So we feel like we have a really competitive workforce as well. I'm very proud, to work with folks I do in this company from that aspect. So it's a great question. It's about doing everything that much better. Yes.
Question. Can you explain that interest rate swap trade?
You bet. I've dangled that out a couple times. So some way for somebody to take the bait. So that interest rate swap trade, again, very unique. Nobody to my knowledge has done it, across the US. And what we saw back when COVID panic hit was there's swap rates. So 10-year swap rates went to all-time record lows. And what is a swap rate? Well, an interest rate swap is you can trade out variable rates for fixed, so you can neutralize the risk of changes in variable interest rates and lock in a fixed rate is effectively a way to think about that. And that fixed rate we locked in at the time, think about, depending on the tenor, how far out, the fixed went, but somewhere between 0.5 percentage point to 1 percentage point, kind of in that zip code. So no matter what happened in the future, we have that really low interest rate locked in. Now, what's happened to interest rates is they've gone up to 5 to 6%. We still have the 0.5% to 1% locked in today. So now we can deploy that. So an example is Catchmark had $300 million in debt, and we refinanced most of that, paid off a little bit, but refinanced most of that. And if I had to go borrow that money today, I'd be paying the 5 to 6%. We ended up paying 1.8%. How did we get there? Well, we fixed back in March of 2020, kind of a fixed leg of that debt. And then there's a bank margin, think of it as a credit adder, that gets added up to get to your 1.8% net of patronage of the farm credit system. So it was really all about fixing that rate back in 2020 and then putting it on a shelf.
And why do you think you were the only ones that did that versus your competitors?
You'd have to go ask everybody else that didn't do it. I don't know.
question about timberland values.
Yep.
How, you mentioned you won several bids in a row and you lost them recently. Can you talk about, obviously the rising interest rate environment, the present value of future cash flows is greatly diminished, yet you're seeing prices continue to rise.
Right.
That's surprising to hear.
Right.
Knowing real estate. So, what is your belief as to why is that? Are there new buyers in the market? What's going on with that dynamic?
It's a great question, and it's multiple factors, actually. It's not one. And Jim touched on a few of those factors in his question as well. But I guess I would start by saying when we go run our models and determine the price we're willing to pay for a set of timberlands, we start with what's the volume of standing trees, what's the age, when it's going to be harvested, price curve, discount rate, we get to net present value. And that determines the value that we're willing to pay. And we do that analysis on a real basis, not a nominal basis. And why is that? Because just like we're seeing today, the price of our products will go up when inflation happens. And that's true with log prices as well. So people have for a long period of time, have held a view that timberlands are an inflation hedge. And that's because the price of your product goes up over time as inflation happens. So we've always traditionally, and we're not the only ones, the industry really does the analysis on a real basis, not a nominal. So that'd be one. Number two is you think about this environment. If you're trying to go find some yield and a good return, timberlands were really attractive compared to what's happening in other asset classes today. Fairly low risks, pretty good certainty on what you're going to generate off that land, and the yield by itself looks pretty attractive today too, even with prices going up. And I would say the third main thing, we could throw more factors, but there's new buyers, non-traditional buyers are being drawn to the asset class. Think about ESG, for example. So IKEA, the furniture, the European furniture manufacturer, owns 150,000 acres timberland in the US. Why? Because they're looking for carbon offsets, and they've decided that owning timberlands is part of the way they're going to offset their emissions as a company, right? Microsoft's, Apple's, others are kind of circling, looking for land. So we're seeing non-traditional buyers coming in and buying land for purposes and uses different than what the land has been used for traditionally. And supply and demand, that's going to push the pricing up.
So what are the long-term growth goals for Potlatch Delta? I know we saw that really large CapEx expenditure, and that was probably directly linked to the really great pricing of lumber for favorable growth.
Yep. So I wouldn't say that so some companies will talk about, I want to buy $1 billion of timberlands over a certain period, or I want to do this. We don't have those kind of goals. And what I do is I would take you, if we had the presentation up, I'd take you back to the capital allocation page. And I would say, and it's back to that deck of cards or that hand that I'm holding every day. What's the right capital allocation decisions? And it may be growth, it may be buying shares. We're in a share purchase mode today. So we don't feel like we should be growing for growth's sake. We'll grow opportunistically as it makes sense, and we can grow the value of this company on a per share basis, just like we'll go buy shares for the same reason. So we don't have explicit growth goals.
So you say you took on $300 million worth of debt, you have a catch mark. Is there any plans to pay that off? When? How?
Yeah, actually, we before we did that, we actually were the lowest levered of the timber REITs. Remember, I showed you the competitor set. So our debt level is the lowest of anybody. So we started with the capacity to add debt in the right instance. But you also have to think about, we added in a cash flow stream as well, in the midst of, probably around an EBITDA basis, probably in the mid 50s. So call it 55 million a year of cash off the catchmark land. CAD basis is in the mid 40s once you subtract interest and capital, reforestation costs. So that additional cash supports additional debt as well. So we started low leverage, but we also took on, a business that can support debt by itself as well. So, we're actually still pretty low leverage today. That's by design, back to my comments about maintaining a bulletproof balance sheet and flexibility. So things get bad, we're in a position to go take advantage. I feel good, we get a down cycle, a real down cycle that affects our business. I feel good that the debt load is manageable in a down cycle, and that's by design.
Yeah, especially when you're at 1.8%. Not gonna pay off that.
Have time for maybe one or two more questions. If there's any other lingering ones here.
Okay, I'm gonna pause. Anybody online? This is I think one of the benefits of being in the room is this group gets to dominate in here. So I want to make sure that online has one more crack. And if not, I got a couple of hands going up in the room. Palmer.
What do you believe is the net asset value per share?
Yeah, good question. So we do run a model regularly. It's a pretty detailed model. Obviously, we have the best information anybody, internally. We don't talk about that publicly. What I will tell you is there are 7 sell side analysts that cover us today. And not everybody calculates a net asset value per share. That's how we think about it in the REIT world. But for those that do, the average is $63 per share is what they estimate. Now, I'd be interested to see what this group of analysts comes up with, because they are always conservative. You hear Jim laughing, but they're always conservative. For example, some of them have Idaho valued as low as $1,800 an acre. And Wayne showed you a slide where on a per acre basis, Idaho is earning more EBITDA per acre than Weyerhaeuser. And we have market data that suggests that west side timberlands are going for $4,500, $5,000 an acre. Now, I didn't just say Idaho's worth $4,500 to $5,000, but $1,800 seems kind of low to me. And there's some other haircutting that goes on. So I'd be interested to see what this group comes up with as you run your models and do your analysis and you publish your notes.
Any others? These are great questions, guys. Especially for folks who don't know the company or the industry. Online, speak now for a whole piece. Or email next week.
Yeah, if I get a long list of written questions, I get cranky.
That's right. You get only
That'll affect your score.
5 for your whole team. So remember that. Now it's good time. Yeah.
For the pulp making business, are there any other major commodity inputs that go into producing that are typically called up?
Yeah, we actually we don't produce pulp as a company. So what we do is you've heard reference to pulp and pulp wood. So really think about that as small diameter trees that we sell to those that are making pulp. Yeah.
I live in Columbus, Georgia. I know how small pines are. It's surprising. I heard you guys
Right.
are out there.
Yeah, we'll be in Columbus next week, by the way.
Nice.
All right, we're off the hook for now.
All right, guys, let's give them a round of applause. Thank you.